Okay, let me ask you something. What if I told you there's this one simple yet incredibly powerful technique that could shield your investments from all that market chaos and, actually keep you on track for your financial goals? It's a discipline that honestly, most investors just ignore. But the really smart ones, they absolutely swear by it. Today, we're going to break down portfolio rebalancing, and it all kicks off with one simple question.
Seriously, this is a question every single investor should be asking themselves. Because look, for a lot of us, especially if we've got that set it and kind of forget it mindset, the answer might be a really surprising yes. Let me just show you exactly what I'm talking about.
I mean, we've all been there, right? You do all the hard work, you do the research, you pick your investments, and you build this portfolio that just feels perfect. So let's say you landed on this classic 60-40 split. You got 60% in stocks for that growth potential and 40% in bonds for a little safety. This was your game plan. Totally deliberate, designed to match your goals to a T.
But then, well, the market happens, doesn't it? A couple of years go by, stocks have an amazing run, and without you lifting a finger, your portfolio has just morphed. All of a sudden, it's this, an 80-20 mix. I mean, that safety net you so carefully built, it's been shredded. And now you're exposed to way more risk than you ever signed up for.
So this quiet little transformation, it has a name. It's called portfolio drift. And honestly, the best way to think about it is like your car's alignment. You know when it's just a little bit off, the car starts to slowly, almost invisibly pull to one side. You might not even notice it at first, but if you don't get it fixed, you're going to find yourself drifting into the next lane. Well, your portfolio, it does the exact same thing, but with risk.
And hey, portfolio drift isn't a sign that you did something wrong. Not at all. It's just the natural, totally inevitable result of your investments doing their thing at different speeds. The real problem, the sneaky part, is that the success of your best performing assets is what's silently and automatically jacking up the risk level of your whole portfolio. And a lot of the time, you don't even see it happening.
So how do we fight this drift? Well, we fight it with a proactive, totally intentional process called rebalancing. Think of it as the systematic, and this is the key word, disciplined antidote that yanks your investments back in line with the strategy you chose in the first place.
You know that classic saying, buy low, sell high? Well, at its core, rebalancing is probably the most practical way to actually do that. It forces you to do it systematically, like clockwork. But its true power, the real reason this is so critical, goes a lot deeper than that.
See, a lot of people think the goal of rebalancing is to squeeze out every last drop of return, but it's not. The real goal here is risk management, plain and simple. It's like a promise you make to yourself, a promise that the portfolio you own today is the one you actually chose to own with a risk level you're comfortable with, not some random portfolio the market just handed you.
All right, so how do we actually put this into practice? Let's break down the key things we need to keep an eye on. First, you've got your target allocation. That's your North Star, your map. Then there's the actual allocation, which is, where the market's currents have actually pushed you. And finally, the tolerance band. Think of this as your alarm system. It's the limit, let's say 5%, that tells you, hey, it's time to step in and do something.
Okay, so you're sold. You're ready to take back control. But how do you actually do it? Well, there are two main ways to go about it, and each one has its own pros and cons.
First up is what we call calendar-based rebalancing. Just think of it like your annual financial checkup. Maybe once a year or once a quarter, you pop the hood, see what's what, and reset everything back to your target. It's super simple, but the downside is you could miss some really wild market swings that happen in between those dates. Then you've got the other method, threshold-based. This one's more like a smoke detector for your portfolio. It's quiet most of the time, but it goes off the second one of your assets strips past a limit you've set, forcing you to take action right when it matters most.
Now, I know what you're thinking. This all sounds pretty simple on paper, right? But in the real world, there are a couple of huge hurdles that can stop even the most disciplined investor dead in their tracks.
First up, taxes. Yep, the big one. See, to rebalance, you have to sell your winners. And whenever you sell something for a profit, you know who comes knocking, the tax man. And if you've held that investment for less than a year, oof, that profit gets hit with short-term capital gains tax, which can be brutally high. So every single time you rebalance, you're doing this mental calculation. Is managing my risk worth this very real tax?
And the second hurdle? It might be even tougher. It's our own brain. There's this thing in behavioral finance called the disposition effect.
And what it means is that we are basically hardwired to do the exact opposite of what smart rebalancing requires. It feels amazing to let your winners keep winning, right? And it feels just awful to throw more money at something that's been losing. But rebalancing forces you to do just that, to turn back your high flyers and buy more of the stuff that's down. It feels completely backwards, even when it is absolutely the right move.
So with taxes trying to take a bite out of your returns and your own brain fighting you every step of the way, how on earth are you supposed to stick with this? Well, fortunately for us, technology has really come to the rescue here. There are now tools that can automate the whole process and basically save us from ourselves.
So let's look at how this plays out. With a traditional brokerage, hey, you've got full control, but that also means the entire burden of being disciplined is on your shoulders. Then you have robo-advisors, which just automate the whole thing, often using that threshold method we talked about to keep you on track. And then you've got platforms like M1 Finance, which do something really, really clever. Instead of selling your winners to rebalance, they just take any new cash you deposit and automatically use it to buy more of whatever you're low on. It's such a smart way to rebalance over time without all that selling and tax tricks.
Okay, but let's be real. Does all this effort, all this discipline, actually make a difference in the long run? I want to show you a historical stress test that proves just how critical this can be when the chips are really down.
I want you to imagine something. Imagine investing your hard-earned money for an entire decade, only to end up with less than you started with. I mean, that was the grim reality for a ton of investors in the US stock market during what we now call the lost decade, from 2000 to 2009. It was an absolute brutal period, bookended by two massive crashes. First the dot-com bust, then the global financial crisis.
So, if you would put your money into a simple S&P 500 index fund back in January of 2000 and just held on for dear life, your annualized return for the next 10 years would have been, wait for it, negative 0.95%. A full decade of patience and all you got was a loss.
But now, look at this. Look at the difference a little bit of discipline made. An investor who had a simple 60-40 portfolio and just rebalanced it once a year, they didn't just survive the last decade, they thrived. They actually earned almost 6.5% per year. How? Why? Because they were systematically selling their bonds, which were doing okay, to buy up stocks at these incredible fire sale prices during the market crashes. This is the power of rebalancing in action. It's not about timing the market. It's about having a disciplined strategy for your time in the market.
So at the end of the day, rebalancing isn't about having a crystal ball to perfectly predict the future. It's about being prepared for any future. It's what ensures that no matter which way the market zig or zag, your portfolio stays true to your original plan. So the only question left to ask yourself is your portfolio prepared for whatever comes next?